What if the smartest investors in the world knew something you didn't? What if, behind closed doors, they were placing billion-dollar bets on companies the rest of the market had already forgotten? In early 2025, that's exactly what happened. Warren Buffett quietly doubled down on a beer empire. Michael Burry, the man who called the 2008 crash, put every single dollar into a struggling cosmetics giant. And Bill Ackman? He staked nearly 1/5 of his fortune on a company once known as Silicon Valley's biggest money loser. 6 bets. 6 legendary investors. 6 stories that reveal not just where the money is flowing, but what it means for your own financial future. So the question is, what do these titans see that everyone else is missing? Let's find out. Our story begins not with the flash of tech or crypto hype, but with something far more ordinary: beer. In the first quarter of 2025, Warren Buffett's Berkshire Hathaway more than doubled its position in Constellation Brands, the company behind Corona and Modelo. Why would the world's greatest value investor bet big on beer in an age where everyone is chasing artificial intelligence and electric vehicles? Because Buffett isn't chasing headlines. He's chasing cash flow. Constellation Brands might sound boring, but its financials? Anything but. 52% gross margins. 39% EBITDA margin, nearly 20% of revenue turning into free cash. Those aren't beer industry numbers. Those are tech company numbers hiding in plain sight. And the stock? Cheap, just 14 times forward earnings. Think of it like walking into a luxury store and finding out the items on the shelf are priced like discount goods. Buffett saw the mispricing, and he pounced. But beer wasn't his only play. Berkshire also made a massive bet on swimming pools. Yes, swimming pools. Buffett's team increased its stake in Pool Corporation by 144%, a company that sells chlorine, pumps, filters, the everyday necessities of pool ownership. Not exciting, not glamorous. But here's the twist. Pool Corp quietly dominates its fragmented industry like a monopoly. It earns over 50% return on equity. It doesn't need huge assets. It just needs to keep selling essentials to a loyal base. For Buffett, this isn't about fads. It's about what will keep generating cash long after the hype fades. Beer, pools, 2 industries most investors overlook. And yet, for Buffett, they're billion-dollar fortresses of stability. If Buffett is the master of buying great businesses, Howard Marks is the master of caution. The Oaktree Capital founder has built a career by avoiding risk, buying when others panic, and waiting patiently for value. So where did he put his money in 2025? Not in flashy AI startups, not in speculative biotech, but in a company most investors have written off as dead: Nokia. Yes, Nokia. The same company whose phones you might have owned in the 1990s. But today, Nokia isn't about phones. It's about infrastructure, the backbone of 5G networks and global connectivity. Nokia generates $19 billion in revenue, $1.3 billion in profit, and unlike most of its competitors, it carries net cash, not net debt. In a world addicted to leverage, Nokia is sitting on a war chest. Marx isn't betting on hype. He's betting on survival, a safe, undervalued backbone business that quietly powers the modern world. It's not the kind of stock you brag about at a cocktail party, but that's exactly the point. While Buffett and Marx were buying boring but safe, 2 other investors went the opposite way. Michael Burry, famous for predicting the 2008 crash, made perhaps the boldest move of all. He sold every other stock and put 100% of his portfolio into just one company, Estee Lauder, a cosmetics empire in crisis, revenue down, profits collapsing, analysts abandoning the stock. So why would Burry bet everything? Because hidden beneath the wreckage is one of the most powerful moats in business: brand loyalty. Estee Lauder still earns 74% gross margins, a number so high it screams pricing power. Even in a bad year, it generated over $1.4 billion in free cash. And insiders, the executives themselves, were buying shares when the market was running away. Burry saw not a collapse, but a temporary storm. And if he's right, his all-in gamble could produce returns that few diversified portfolios will ever see. At the same time, value investor Mohnish Pabrai was making his own contrarian bet on oil. Specifically, Valorous, an offshore drilling company that went bankrupt in 2020, only to be reborn leaner, stronger, and profitable again. Wall Street ignored it, but Pabrai put nearly a quarter of his fund into it. His logic was simple. The company trades at just 8x earnings. offshore drilling is coming back, and Valaris is positioned to benefit from the cycle. It's risky, it's cyclical, but in Pabrai's words, heads I win, tails I don't lose much. Finally, we come to perhaps the most surprising success story of all, Uber. Once mocked as Silicon Valley's money pit, Uber was the company everyone loved to hate. Billions in losses, regulatory battles, a broken business model. But in 2024, something changed. Uber became profitable, massively profitable, nearly $10 billion in net income, over $6 billion in free cash flow, and 30% revenue growth on top of it. Wall Street still thought of Uber as a money loser, but billionaire Bill Ackman saw the truth. In Q1 2025, he made Uber nearly 20% of his portfolio, his single largest position ever. Why? Because Uber had finally matured into something rare, a global platform with scale, network effects, and real profitability. It wasn't hype anymore. It was cash. Ackman wasn't alone. Hedge fund legend David Tepper doubled his Uber stake as well. Together, they saw what most didn't, that Uber had just crossed the threshold from survival to dominance. Beer, pools, telecom, makeup, oil, ride-sharing. At first glance, these bets couldn't be more different. But look closer, and a clear pattern emerges. 1. Cash flow. Every single company here generates strong cash or has the ability to return to it quickly. 2. Pricing power. From Estee Lauder's 74% margins to Constellation's beer brands, these companies can raise prices without losing customers. 3. Mispricing. The market either gave up, Uber, Nokia, Valaris, or failed to notice, PoolCorp Constellation. The legends stepped in where perception diverged from reality. 4. Conviction. These weren't half-hearted bets. They were bold, concentrated plays, the kind that signal true belief. 5. Patience. These investors aren't looking at the next quarter. They're looking at the next decade. So what does this mean for you? No, it doesn't mean you should rush out and copy every trade. These investors have resources and risk tolerance most of us don't. But it does mean this. The path to building wealth isn't about chasing hype. It's about finding value others overlook. It's about patience, conviction, and the courage to buy when the crowd is selling. The next time you see a company written off as boring or a brand left for dead, ask yourself, is there hidden value here that others are missing? That's the question Buffett, Marx, Burry, Pabrai, and Ackman asked. And in 2025, their answers may well define the next decade of investing. Because sometimes, the biggest fortunes aren't made in the spotlight. They're made quietly, in the shadows by those willing to see what no one else can. If you want to keep learning about the financial and geopolitical world, please hit the follow button and like the video.